Welcome back to the Stevens Group Podcast. I'm your host, Chris Stevens. Today we're talking about something that affects every single one of us, but a lot of people avoid thinking about it until it's way too late. Our financial future, my guest today is Jeff Feinendagen, managing partner of TS Financial Group and CEO of 15 Wealth, and an independent financial advisor who has spent years helping individuals and families navigate one of the biggest questions in life. How do we actually build a plan for retirement that works? Jeff doesn't just manage investments. He builds financial planning software designated to simplify the retirement income planning process and help people make smarter, clearer decisions about their money. In today's episode, we're going to talk about retirement planning, common financial mistakes people make, and the future of wealth management and some practical strategies anyone can start thinking about today. Jeff, Eric, thank you very much for joining us on the Stevens Group Podcast.
Thanks for having us. I know we've been trying to get this going for a while now. So
Yeah, you're a busy man. It's hard to get on your calendar.
Absolutely.
All right, thank you. So Jeff, give our listeners a quick overview of the journey into wealth management, what led you into the financial advisory world.
Great question. So back in the day, and Eric and I are both econ finance majors, right? We went to the same college. And out of college, I got into lending at a big credit union. And then I was fortunate enough, my partners asked me to become an advisor when I was 28. And I didn't know what I wanted to do, but when I got into it, I was so passionate about it. And I've been doing that for 26 years now, which is great.
Yeah. Well, you mentioned that relationships and clients are one of the most rewarding parts of your work, right? What is it about helping people in their financial future that keeps you passionate about the industry?
So we both grew up very poor. Like we had no money. Like we were dead broke, right?
What he's trying to say is we had to share a bedroom.
Yeah.
Yes.
Oh, absolutely.
Bunk beds.
Well, there was actually 6 of us in a 3-bedroom, 1-bathroom house. That's actually a true story.
So we learned the value of stretching a dollar.
Stretching a dollar.
Yeah.
But when we grew up, I literally had no money. And as an advisor, I learned really, really well how to accumulate, right, money. And it became, no one ever taught me, but it came very natural to me, right? And I'm able to now take all that knowledge of accumulating my own wealth and help other clients do the same thing, which is awesome.
And Chris, I just add also, in 15 Wealth, one of the things that we're doing now is financial literacy. We're proactively working with the community and clients to educate them. Because to Jeff's point, you go through school, you learn physics, arts, science, but are we really learning the laws of money?
Yeah.
And, I was just having this conversation with another client, and she said, Eric, I love the fact that you're offering this education because it's the younger generation. Sure, they may learn social media skills or how to, text fast, but are they truly learning financial literacy? And that's something that we're both passionate about, given our background and developing those relationships.
Absolutely. It's terrible that they don't teach this in school.
I know.
Absolutely.
They're getting normal stuff out of the schools, like normal things that you would think people making life decisions should know how to do.
Completely.
And unfortunately, they're not doing that.
One of the things actually we did a couple of years ago was during the summer, we're going to do this again, by the way, for listeners who want to participate. Kids in college, right, who are studying finance, econ, who think they want to become a financial advisor, but they're not sure, right? Or they want to learn just more things about money and how to accumulate wealth and entrepreneurship. We did a class, and we did it, it was free. So once a week for about 2 hours, end of the workday, I think we had 14 boys and girls, right, all college age. And we get together and I would teach them, here is the day in the life of an advisor. Here's what I did every day. Here's why the markets moved the way they moved. Here's my entrepreneurial journey. And every one of those kids said they learned more in that summer than they did in all their college classes.
Absolutely.
Which is phenomenal. So by the way, we're going to have that again this summer. And we'll have it in our new facility. I think we'll be able to take somewhere between 20 and 40 college kids and then teach them that for free.
Awesome. That's a great thing that you're doing for the community as well. What are some of the biggest financial concerns people are coming up with right now?
So we just came off of 3 really good years, right? 23, 24, 25 were phenomenal years in the market. So everyone is now worrying about, is there an AI bubble, right? The markets are too high. Is there going to be a pullback? So that's one thing. And when we talk that through, the key thing there is because we can't predict what the market's going to do, and obviously they're pulling back right now with the war, but we can't predict it. So we always tell people you have 3 things. If you need money within the next couple of years, right? Whatever you need, we need to keep that pretty safe. 2, we run through a retirement plan minimum once per year with them. So is your plan still intact, right? And then 3, are the investments that you're currently holding good investments, right? And when we manage money, we'll tactically trade. Like we added gold to the portfolio back in November of 24, and we like emerging markets. So we'll move money around tactically as we see the economy changing, but you cannot predict right? When Trump did tariffs last year, right? We saw a 20% pullback in April, and then the market rebounded and had a phenomenal year, right? COVID, markets pulled back 35% in a matter of a couple months, and yet it was a positive year. So it's very, very difficult to try to time the market. And we always tell people you have to take emotion out of that, which is one reason why AI will never replace the advisor.
I agree. Absolutely. When someone comes to you for the first time, what are the first things that you look at when you're evaluating their financial health?
Yeah, good question. So it's really interesting. So before we recommend anything, we always sit down and do a full plan, right? And I look at obviously where they're at, so their age, how much investments they have, and how much money they make, right? Because if you make a really, really good income, but you don't have a lot saved, that tells me you're not living within or beneath your means, right? Which, by the way, is one of the principles at 15 Wealth. I have 15 core principles, right? So go to the website to learn those. And those are the principles that have shaped my life and my wealth. So we look at a client, we look and see, and one thing I always hear from them is, I wish I met with you sooner. So that is, one big thing is people always wish they started planning sooner. But we look at how are they doing? Can they do this on their own? Do they have debt? Just how they spend their money, because that will flow into their retirement plan pretty significantly.
Yeah.
So Chris, I'll just jump in real quick. The conversations that I have with clients are a little bit different than what Jeff has. Obviously we're both relationship driven individuals, but Jeff focuses a lot on the numbers, and I like to take more of a holistic approach. So, when somebody comes in for the first time, I like to find out, all right, well, what's your background? What are your goals, not only financially, but spiritually, relationally, physically? Because when you get to understand the person as a whole, that adds into, the financial aspect as well, because everything comes together. And, Jeff and I, we're fitness enthusiasts. We like to talk a lot about health, mental health, physical health. If you're taking care of all the other areas in addition to financial,
Yep.
It all comes together, and now you're rich and wealthy in a lot of different areas, not just financially.
Yeah.
Yeah.
It makes perfect sense.
Although people do, we need to really get to the crux though, when I get into the details of what do they want money to do for them?
Yeah.
Like, what does it mean? Is your goal to leave money to your children, your grandchildren, your heirs? I hear a lot from clients where they want to die without a penny left, right? And I always say that if you can tell me, if you can tell me when you're going to die,
we can plan into the day.
right? So it is interesting, but there's so many ancillary things that they're not thinking about,
Yeah.
which is why we spend a lot of time in that planning sessions, and whatever plan we do initially, by the time we meet a year later, it's completely different.
Completely different.
Different job, different life events.
Priorities change.
Absolutely, which is great, because for a lot of couples also, what I've noticed is the first time they've actually talked about money is in front of me. So I always joke about this. I'm part-time marriage counselor because it's very clear they've never talked about this, and and they like who pays what bill and whatever the case may be. So it's it's unique.
Fact finding and therapy.
Yes, absolutely.
Absolutely. What are some of the most common mistakes that people make when planning for retirement,
So
other than like waiting too long?
yeah, I was gonna say the easiest one is waiting too long, right? When we do a plan, one of the big things we will look into is, well, how much do you need at retirement, right? And people have their budgets and so forth. And one big thing that they kind of forget about is life isn't super smooth in it, right? Things happen, and we have to plan for the unexpected, right? So that comes into plans quite a bit. But overall, it's making sure you're contributing again systematically, right, to your 401k, your 403b, your Roth IRAs. So that's your qualified accounts. But then everyone also should have a non-qualified account, money that's still invested, but you can access before 59 and a half.
Yeah.
So a lot of people, right, their majority of their money is in those qualified accounts. But I'm always like, we need access to money sooner. So you have to save in both areas. And a lot of people don't do that.
Makes perfect sense. So people that are in their 30s and 40s, what are the most important financial habits that they should be building today?
So you want to, one of my big things that I touched on earlier, you need to live beneath your means, right? So that you have the ability to save. So when you're in your 20s, you're figuring out your job, okay? You start to settle into your career pretty well, I think 30s and 40s, and you start to make money. And for myself, right, I still live in the exact same house I did, right, 22 years ago, right? So I've always lived beneath my means, and I've saved. And I'll think a lot of people in 30s and 40s, right, will go out and buy a car they actually like that matches their income, or they'll buy a house that matches their income. And what they should be doing is buy that car and that house that's below their income that they can afford, and then take that other money, right, and then save and invest that. And when you do, what that does is it allows that person later on in life, whether it's 30s, 40s, is to take calculated risks, which again is one of my huge principles for accumulating my wealth, is I've taken massive risks. And had I lived at my income level when I was in my 30s and 40s, I never would have been able to take the risks that I have to then grow my wealth.
Yeah.
And that is I think the number one most important thing is, right, slow down, save a lot of money so that you can then have choices. Or if you want to like be entrepreneurial and start your own company, or maybe switch a company, or you need a 6-month sabbatical for mental, right, health. If you don't have that savings and you have to have the paycheck, then you don't have those choices.
Yeah. Chris, I'll throw something into the mix here. 20s and 30s, and just something I wish I would have done when I was that age, is sit down and actually have a budget. Again, we're talking about what's taught and what's not taught in school. Were we really taught to have a budget growing up?
No.
Great, maybe you balance the checkbook, but there are so many apps out there right now that, one can use to have a budget. And the budgeting, okay, what are my savings goals, right? What am I spending toward entertainment, toward food, toward travel?
Yeah.
And when you categorize spending, now you can see trends. So, Jeff and I, we bank at the same place, and every year at the end of the year, we get a printout of, what we spend on our credit card. And I'll look at it and say, oh my goodness, I spent that much on fast food, on restaurants.
Yeah, I love now that it categorizes them.
Well, correct. And it's, it's a reality check.
Yeah.
So people that are starting out, trying to develop wealth, if you have a budget, you can see the trends early, and then you can fix those trends.
Yeah, course correct.
Yeah, course correct before it's too late.
Yep.
Well, the other big thing with that is if you set up a periodic contribution into your brokerage, and so you treat that as a bill, then you're able, guilt-free, to spend your other money because you've already set that as the priority.
Yeah. Makes sense. How much should people realistically be saving if they want to retire comfortably?
Oh, great question. It's completely open-ended.
100%?
Yeah, completely open-ended. So every one of my clients has a different level of expense, right?
Yep.
So, excuse me, some people need, they're like, I can live on $4,000 a month. And it's like, oh, great. Social Security is half of that. We don't, right? But some people need $20,000 a month
Yep.
plus travel and so forth. So what I tell people is, at the end of the day, if you have a good income or even just an average income, it doesn't matter. You still need to save accordingly, right? Because most likely in retirement, you'll probably live a similar lifestyle. But the biggest fallacy though I think people have is, right, let's say they make $250,000, right, household, right, which is a good income for the household. And then
Not anymore.
I know not anymore, but you know what I mean. But then they're like, oh,
Depends on where you live. Right.
but then they're like, oh, we
What
can
county?
live on $5,000 a month, and I'm like, you sure? Right? So
Yeah.
we want to have realistic expectations, right? Because they make this good income, but they don't have much in savings. So I'm like, so you're spending every penny you make, but you think in retirement you can live on a lot less, right?
Yeah. Doesn't
I
make
think
sense.
it's a
Why-
fallacy. So to your question, there's no written rule. I tell people literally save as much as you can, and if you're living beneath your means, we should be able to save enough to make the plan work.
You hear all the time about people making $250,000 a year that have nothing.
Oh yeah,
And then you have people that were janitors that retire comfortably.
correct.
Right? And so it's not an income problem. It's a savings problem. It's a
Yes.
planning problem.
And a spending problem.
And a spending problem.
Yeah. So one more quick thing. I'll add a strategy I think your listeners can take advantage of. And this is a strategy that Jeff and I not necessarily wanted to use growing up, but were forced to use, which is delayed gratification.
Yeah.
Quick story, my father-in-law, when he graduated high school, went right into the trades. It was a butcher and worked as a butcher at Jewel for 40 years. So, modest wage,
Yeah.
hourly wage worker, but he was smart because he did two things, which Jeff talked about. He saved as much as he could and practiced delayed gratification. Believe me, there were many times where he wanted to buy that new car or, take that vacation. And again, he would reward himself. But what he did was he accumulated, he kept investing. And now in his retirement, he's living large.
Yeah.
Right? So here's an hourly wage butcher, high school education, who is a multimillionaire. He drives, a Class A RV. He lives on 5 acres, house paid for, unbelievable. He goes on vacations whenever he wants because of the principle of delayed gratification. Yeah. And, my economics teacher said something to me, when I was a sophomore in high school, which I've never forgotten. He said, Eric, you can either pay now or you can pay later. And it's a lot more expensive to pay later. So let's pay now, practice that principle, and good things will happen.
Makes perfect sense. What are some of the biggest misconceptions people have about retirement planning?
So they think, right, when we figure out that monthly expense that they need, that they're good. And every single month, clients call me and they need more money, right? That was not in the plan.
Yep.
And it happens. And again, this isn't one client, it's a lot of clients, right? So it's planning for the unexpected, not planning for unforeseen medical,
Not
right?
planning for inflation.
Inflation. So there's a lot of good risks. I'm going to brought that up. Inflation risk, longevity risk,
Yep.
right? Do you live too long? Sequence of returns, stock market risk, meaning when you retire, if the market drops 20% when you retire, let's say you have $1 million, right? For simplicity, now you're at 800,000 and you were planning on pull off 50,000 off of that million.
Yep.
Well, now you're pulling off 50 off the 800, right? And what if the market doesn't recover for 2 years? That 800 could keep reducing. So that sequence of returns, market risk when you retire is pretty important. So yeah, it's inflation, taxes, longevity,
Unforeseen risk.
unforeseen risk,
Yep.
Stock market risk.
I like to look at it as two different buckets. You've got income shocks and spending shocks. Income shocks, okay, great. There's a layoff at the company or there's a merger. All of a sudden, you're a high-level executive. Now you're out of a job,
Yeah.
right? That's an income shock. or you're in sales, right? The commission's not as good as it was last year. We have to be able to save for that. Spending shocks, it's the unexpected. Something breaks. It's 100 degrees outside. AC breaks. You got to fix it. You have no choice, right? You need that AC. Personal example, my son was diagnosed with type 1 diabetes 2.5 years ago. Insulin costs a lot of money. That Dexcom is expensive. Going to the doctor on a regular basis, right? It affects the monthly income, or the monthly expenses. Yeah. So those are things, right, that we have to plan for. Obviously, having my son being diagnosed was something that we would never expect. It's not in our family, but now we have to adjust for it. And if you plan appropriately, it's not as big of a shock as it would if you were spending, over your means.
A lot of people worry about running out of money in their retirement. How do you help clients create confidence around long-term income strategy?
Yeah, that's great. So we call that the bag lady syndrome. You're absolutely right. People, that is their number one concern, is running out of money. It's a real thing.
Jeff, okay, I've been in the industry with Jeff for well over 2 decades. I've never heard you talk about that. Okay, now I need to be listening to Jeff a little bit more. Okay, so guys, bag lady syndrome.
So, and again, if we control, right, like when we run their plan, we make sure there's a lot of money left over, right? Because you can't.
More conservative approach.
Yeah, you cannot spend it down. So we use conservative rates of return when we're planning. There has to be a nest egg at the end, even though they want to spend it down, to account for all of those unforeseen, right? And we'll also look at what we call their income stability ratio.
Yeah.
So actually, my brother-in-law, Dan, and I came up with that ratio, right? He builds tech for me. That ratio is basically how much guaranteed income, or how much the income you need during retirement is guaranteed. So Social Security, pensions, right? What percent of that is there? Rental income can increase your income stability ratio. Is it an annuity with a living benefit right or appropriate? Maybe it is, maybe it's not. But we will look at all that, and we'll also look at that client's emotional determines for risk, right? How do they react?
Tolerance.
Right? Yes, thank you. Tolerance is the right word. So basically, we'll look at all that and then come up with that plan to say, okay, you will not run out of income, right?
Yeah.
And that's
Stick to this plan.
That's the thing why people use me, right? I've retired a lot of people. No one's run out of money yet. So that's the
good
thing. Yeah.
Yeah. I mean, unfortunately, with rise of different costs, right? People don't plan for roofs. I'm in the real estate industry. I run into people that they plan for retirement, and all of a sudden the tax bill went up 40%. And now all of a sudden they don't have enough to pay their tax bill. And unfortunately they paid off their homes, or there's people out there that are buying up tax liens, right? That's the biggest thing. Somebody pays off their mortgage and they went and they escrowed their taxes forever. And now all of a sudden they never got a monthly bill. So they didn't pay their taxes for 5 years. And now all of a sudden their taxes got sold after 5 years. Now, they also didn't open up their mail for 5 years and notice, but they were getting those tax bills every year thinking, and they were just getting paid for it, right? So some of these elderly people, those are some of the things I run into, or people running out of, they can't pay for a roof repair.
Yeah.
They don't have that extra 20, 30,000 laying around. Yeah. And those are some of those unexpected things that were not predicted for, or a furnace and stuff like that. And that's where, even if people are sticking to the plan, but like you're saying, if you're extra conservative and now you have all these extra things, now these life events aren't going to totally cripple you.
Correct. Absolutely right.
So I love that. Well, let's go here. If someone's listening and hasn't done any formal planning yet, what are the first steps that they should take?
So besides meet with an advisor, right? You have to take a look at your budget. Eric mentioned this. So how much income is coming in and what's going out, right? And if you're not saving and you're spending what's coming in, either you have a really bad job or you're just spending too much money, right? And you have to prioritize putting money away. So like at a minimum, if you're at an employer and there's a company match, right, which is literally free money, you absolutely need to be contributing for the free, right? And the younger you are, the more it makes sense to do a Roth versus traditional, right? We want that tax-free compounding for decades, right? So it's figuring out just how you start saving. And then when I tell people, even if it's a 401k, you go and put away 3%, let's say, each year when you get your merit increase, don't take the merit increase in the sense of through your paycheck. If you get a 3% merit increase, take your 401k now and contribute 6% and then 9%. So slowly your
Great
paycheck
concept.
stays the same, but you keep adding into, right, that contribution. And Eric touched on this, the whole principle of delayed gratification. Never buy anything that you can't afford to pay cash for, right? And after you've already done your savings. So the new furniture, the new house, the new whatever. If you financially aren't already have those things in place, don't do it. It just makes complete
So
sense.
today's a good learning experience that I've pretty much screwed up my entire life.
It's these are when you ask.
It's never too late to
It's
change.
never too
It's
late,
never
though,
too late.
right? It's never too
No, it's not. We grew up very poor, right? My mother literally was the single earner, and she put us through private Catholic grade school, high school, and college on a nurse's salary, right? So if she can do it and has a successful retirement, anyone can do it.
Yeah.
It's just we didn't have the luxury items, right? We would take a school bus to Ohio to swim in my aunt's pool. That was our one vacation per year, right? So it's like, it's a true story, right?
Yeah.
Like you know.
So, and a couple more things to build on what Jeff was saying. So now it's tax season, right? We're going to get those tax refunds. What a lot of people do, they go out and they spend it, right? Okay, what can we buy? Well, sure, reward yourself a little bit, but then always look for ways to increase the savings rates. Can I put some of that, into savings and let that grow and compound over time? Because, compound interest, right? One of the greatest powerful forces on planet Earth.
Yeah.
You let that money grow, let your money work for you.
Snowball effect.
Yeah, rather than you work for your money. But I have to add one more thing before we end this, because it's something that I deal with on a regular basis, almost weekly at 15 Wealth, which is this cybercrime, scams,
Yeah.
frauds. We were talking offline that the third largest economy in the world is cybercrime. And unfortunately, I get a call, almost weekly from a client who either was scammed or was tried to be scammed. And I would just add this to the listeners: don't send the money. I don't care how good it is. If it sounds legit,
Don't make the phone call
correct.
that says, "Oh,
Yeah.
there's an error on your account. Call this number." Don't respond to the email. Don't respond to the text. Don't respond to the phone call. Right? Call either a trusted person in your life, right, or your advisor, and get a second opinion. Because it's true. We see people, very, very smart people, fall to scams often.
And a lot of times it happens with people that, have lost a loved one or living alone. And, these scammers, what they'll do, the bad actors, is they'll build a relationship, right? They won't ask for the money right up front. They'll build trust over time, and then they start asking for the money. And, unfortunately, bad things can happen. So just be wary of that.
I love it. Thank you
Yeah.
for adding that
Yeah.
to our listeners. From your perspective, working with clients, what financial concerns do you hear about the most?
So concerns, again, unforeseen medical comes up quite a bit, right? That's a big one. Long-term care is a big topic of conversation. As we have an aging population, right? Boomers. And so clients are seeing firsthand what their parents are going through, right? And they're spending $10,000, $12,000 a month on assisted living, right? At home care. So it's something that we really need to factor into plans while we look at that, right? Do you self-insure? Do you take out a traditional long-term care policy? When do you take that out? Right? Do you do a life long-term care combination hybrid plan? So there's a lot of different options, but it's something everyone should look at. The other thing that we see all the time is probably 90% of people do not have their estate in order. They do not have a will. They do not have a trust. They do not have a power of attorney, or they did the will 20 years ago and it's out of date. Probably 90%. So, and I'll give you a little bit of background, right? So my primary job is TS Financial. We didn't really touch on this. 15 Wealth. We created 15 Wealth about a year and a half ago. It's really a platform to help other advisors grow and succeed. And we have a full back office support. And the whole key with that is collaboration, okay? But part of 15 Wealth, we have our own in-house insurance agency, right? All lines. But then on top of that, we're able to either refer to attorneys, right? Or we can help give high-level just advice on, not really advice, but consultation on helping get your will and trust plan in place, right? And then refer out to the appropriate professional.
Point them in the right direction, making
Exactly
sure they're right and taken care of correctly.
Which is really, really important.
Yeah, which is great. Yeah. If listeners want to connect with you and learn more about your work with both of the different organizations, where should they go?
Great question. So I'm on tsgroupllc.com or 15wealth.com. So they're like sister companies. I'm accessible on either one, right? Or Facebook or LinkedIn.
Yep.
Any of those work.
All right. What surprises people the most when they actually sit down with you with their finances?
Some people are actually surprised when I'm like, yeah, your plan looks really good.
Yeah.
Right? They're like, oh, this is awesome, right? So I think,
Reassurance.
yeah. And again,
Decidedly.
yes, 100%. There are a lot of people are very nervous, right? They're like, okay, that's one of the first questions. Have you ever met with a financial advisor? It's either yes or no, or I just don't know what to do. Or if they have like a lot of debt, they're very, very nervous since we have to come up with a plan of how we get them out of that, right? But it's really rewarding to see us literally be able to transform and take away that pressure. But knowing that they can retire at some point is like very reassuring to them. And that's, I always joke, I say, I like people and I love money, which is why this job is great for me, right? But realistically though, I love all my clients. I love what I do, and money, for whatever reason, comes very, very easy to me, right? It's very natural. I get it when I see the plan. I know exactly what to do. So it's very rewarding helping people. Like, okay, good. Here's exactly our plan, what we have to do. And I've been doing this 26 years. So I've seen people, literally as clients and till they pass away, right? So I see the full gamut of their life and, being able to take them through. And now I'm working with their children, right? So it's kind of a cool experience.
That's awesome.
I like to think of it as we're dealers of hope. A lot of people come in to see Jeff and they have this hopeless look in their eyes. I've been working. I don't know where I'm at. I'm lost. What am I going to do? So I'll see them walk in. Then they spend about an hour and a half with Jeff. And then they walk out and they're floating like on cloud 9, right? Because Jeff, you're the deliverer of hope, right? So, it is great to see people just be able to, have a sigh of relief in whether it's, hey, you can't retire early. You can't retire at 58, but if you do this, this, and this, based on the plan that Jeff, puts out for you, maybe you can do 61, 62. And just knowing that, it relieves the anxiety, lets people, again, just breathe and live a little bit easier. And that means the world to us.
Yeah, absolutely. That's awesome. What's one financial decision people make in their 30s and 40s that often regret later in life, other than like bottle service and stuff like that? That's where I went wrong in my 20s.
Yes, that's good.
I wish I had all the money I spent on bars and restaurants from my 20s.
Yeah, and we've touched on it, right? Not like maxing out their 401ks early enough.
Yeah.
So basically overspending, not saving enough. The other big one, which, right, is life insurance also. I've had clients that, as kind of a basis for any plan, you have to have a protection, right? I always tell people, most people are way underinsured, right? And I look at them, and if you're making It doesn't matter what you're making, right? But a husband, wife, and 30s, 40s is the perfect time, right? You're healthy. Get a boatload of, honestly, term life insurance. It's cheap, right? Because God forbid something happens, your spouse or children could be absolutely screwed, right? And the reason why you get a large term outside of your employer is because, well, it's always good. If you have a job and you're laid off or you have a different job, you're not covered for that time. And you don't know what could happen to you health-wise where you're uninsurable later. So something that, it's not a massive focus for us, but we always bring it up. And again, it's more of a just get a boatload of cheap term, right? And get that protection in place so that when the unexpected happens, you're covered.
All right, Chris. Now, here's something that's going to probably throw your listeners for a loop, which is those that look poor are usually rich.
Yeah.
Those that look rich are usually poor. And why do I say that? Social media. You asked what the biggest mistakes people make in 20s and 30s, and I would say everybody is the comparison trap. Oh, my neighbor or the person I graduated with, they're driving this or they're taking these vacations. Don't fall into that trap, right? It's not about keeping up with who you know. It's about your individual plan, what's important to you, taking care of your family. And we all fall into it. Go onto social media. It's everyone's highlight reel, and you feel that FOMO. And again, resist that urge to compare, because then you're going to start overspending, not saving, and then deviating from your plan. Stay with the plan that Jeff put together for you.
Yep.
And then, keep going back, and you have to revise it. Great, but don't fall into that comparison trap.
Love it. What's one financial decision people making in their working years that can cost them hundreds and thousands of dollars in the retirement?
Letting emotion dictate your investing. So literally, this happens all the time. They think they can predict what the market's going to do, right? So let's say in their 401k, oh, there's a war. So now you have to predict when to get out of the market and when to get back in 2 times perfectly right? So they will move money right out of the market or go more conservative on emotion. And then what happens typically, and I've been doing this 26 years, it happens every single time. It will take COVID as example. We'll take the Trump tariffs as example. Market drops. And when I start to get phone calls from clients starting to panic, that tells me we're typically about a week away from the bottom, right? So the market's going down, or if they're doing this on their own, right, they'll get out here, right? And then what happens is market rebounds, but then in your mind, because it's not a straight up, it's up, down, up, right? Yeah. But it gradually goes up. And then typically what happens then is they always buy in at a higher level, obviously, because they missed the rebound. And that will cost people hundreds upon hundreds of thousands of dollars. I had one client, no longer a client, and he never made any money with me whatsoever because he would not listen to me. And he always would say, get me out. Take me to cash and then tell me when to put him back in. And he never made any money because he let emotion dictate that investing response. And at some point I was like, why are you even talking to me? What's that? Right?
Yeah.
Because of that. So
let's talk about, to your question about debt.
Yeah.
And, unsecured debt. If you look at as a whole, Americans, in this country, we're looking at our household debt is more than the GDP of a lot of small countries.
Yeah.
We're looking at trillions of dollars.
And I think credit card debt is at an all-time high.
Credit card debt's an all-time high. So what keeps people, from being able to achieve their financial goals? Unsecured debt, taking on too much debt, paying high interest. So in addition to having emotions take over, debt keeps people living in the past. Mm-hmm. We do not want to live in the past. We want to live in the present, right? And enjoy the present. So if there's a way that your listeners can, remove some of that debt out of their lives, not take on that debt, pay it down, then I think it's going to be an advantage to them.
That all
Going
gets
forward.
back to delayed gratification,
Yeah.
right? If you can't afford the trip to Disney and you're going to put $5,000 on your credit card, you probably shouldn't take the trip to Disney.
No,
So
makes perfect sense. But you want to get those points.
I know it's
If you're not going to pay off the credit card
I
when
put
the bill
everything
is
on my
in.
credit card. I have a lot of points.
Mickey has enough money. Mickey and Minnie live in a very nice
They're
house.
doing well.
They
They
actually
don't
live
need
in
our
a
money.
castle. So they don't need any more of our money.
And we talk about delayed gratification. It's so hard nowadays with the younger generation,
Yeah, absolutely.
right? And there's so much education to be done. So I love what you guys are doing with 15 Wealth and educating our youth and college kids, because that's where a lot of times college kids are getting into debt or going into.
Correct.
They're coming out of college with not just student loans, but credit card debts, low. They can't even get an apartment sometimes. I see because they racked up so many debt. And not only that, missed a couple of late payments, stuff like that, so their credit scores are lower.
Yeah,
so we see that,
it's a
and it's
yeah,
a
snowball.
revolving downward spiral,
Yep.
right? And but like you said, it's keeping up with the Joneses. Well, this is what everyone's got the new Aloe sweatshirt. I need an Aloe sweatshirt.
Yep.
Ringing it up on the credit card, stuff like that. Just keeping up with the Joneses. So hopefully, not only are our listeners going to be maybe parents, but maybe the kids might. Maybe the parents will have the kids tune in as well.
Yeah, absolutely.
Absolutely.
All the college kids come sit
Yeah.
in their sessions over the summer.
Awesome. Well, this has been awesome, guys. Thank you so much. Jeff, Eric, thank you for sharing your knowledge, all your expertise, and years of relationships with your clients and hopefully our listeners have some great things.
Yeah, thanks for
to learn
having us.
today.
This is super fun.
Absolutely. Thank
Right.
you.
Thanks.
Thanks for having us.
Jeff, Eric, that was a great conversation, and I really appreciate you sharing your perspective and experience with us. I think one of the biggest takeaways from today is the financial planning isn't just about numbers. It's about creating clarity and confidence for the future. And the earlier people start thinking about it, the better position they are. For anyone listening who wants to learn more about Jeff and his work with 15 Wealth Management and the TS Financial Group, or the tools he's developed to simplify retirement planning, we'll include links and information on the show notes. And to everyone tuning in, thank you for listening. If you enjoyed this episode, be sure to subscribe, share it with someone who could benefit from it, and keep building the knowledge that helps you make smarter decisions in life and in business. Until next time, this is Chris Stevens. Thanks for being part of the show.